Hi there, Internet. My name is Wes, and today we're going to look at Disney. I've been bullish on Disney for a while, but the price has been dribbling down through this year and is sitting roughly at the same level as it was 1 year ago. I thought this would be a good time for me to look at my original thesis, review the company, and decide whether I should stick with my investment. Let's take a look. I don't think Disney needs much of an introduction. It is, as I said, a global entertainment company. It operates a number of different areas. This makes it quite difficult to value the company, though. So it operates theme parks, resorts, a cruise line, broadcast TV networks, and related products. It has a number of diverse businesses, and it is pretty good at creating synergies between these business types. For example, there is a new Spider-Man movie that is coming out, and there will be the movie, which will then be moved to its streaming services, which will also be turned into potentially books. Maybe there will be it that will serve as advertising for a cartoon that they have, a Spider-Man cartoon that they have for kids. There will definitely be many toys that are created out of the Spider-Man movie that they will sell. There might be some sort of feature at their parks that you can go visit, etc., etc., etc. You get the picture. The way that the Disney business is broken down is into segments, and unfortunately they change the structure of the business. They keep on changing these segments every few years. So 2015 or 16, they started reporting earnings across 4 different business segments, whereas at the beginning of this year, they collapsed everything into 2 business segments. This makes it a little bit difficult to value the company because in valuing a business, you are almost always going to have to lean on historical numbers. And because the businesses are so different, the business segments are so different, some are physical property-based companies that employ tens of thousands of people, and others are more like software businesses. It's almost meaningless to form those estimates on the top line, on the summarized numbers. You need to dig one level down into the business segments themselves. But I'll talk about how I've attempted to do that later on. So here you can see the business segments as they've been used historically, and I've more or less used these in my estimates. So linear networks are the largest part of their business, and then tied in second place we have direct to consumer, which includes the things like Disney Plus and Hulu, as well as parks, experiences, and products. So just so that we have an idea of this going into the conversation, linear networks operates a long list of properties, domestic and international cable. Cable is actually still a very large business. I don't think people realize this, and I think this is great because it means that streaming giants have a lot of room to grow into. I think it'll take many years to get there, maybe a decade to get there, but the TAM, the total addressable market, is enormous, and I don't think cable networks are going to survive 1 or 2 decades out. Direct to consumer, like I said, includes Disney Plus, ESPN Plus, Hulu, the streaming services, content sales and licensing. This sells film and television content to third-party TV and subscription video on demand services. So if Netflix shows a Disney movie or series, they need to buy it from Disney. It also includes a number of other things, so you can read through them here. And then there are the parks, experiences, and products. In terms of the coronavirus lockdowns, this area has been hardest hit for the longest time. As we saw, it was a massive money earner for them. And the second area that's been pretty hard hit are the linear networks. And this is because some live sporting events just couldn't happen during lockdowns. So those 2 areas are still in recovery within the business. I did want to talk about Bob Iger recently just because he's a great leader. This is the man that led the company from 2015, 2005 to 2020. And under his leadership, the company grew massively, particularly through some very good acquisitions. The company is very good at buying expensive franchises or products and then turning them into a hell of a lot more money. An example of this would be, so these are just film franchises and series, so this is how much money they made in billions across the world. The Marvel Cinematic Universe has generated $23 billion just at the box office. Star Wars has generated $10 billion just at the box office. And we all know that Disney makes a lot of money out of these franchises outside of just the movies that are seen at the cinema. I wanted to flash this up quickly just to show you how big this company is. It's very difficult for a company that does a number of things to be successful. Typically, a company is best if it focuses on one type of thing and does that thing very, very well. However, Disney does many things very well, and so is a very rare company. So we can see that there are a number of different Marvel companies for making movies, toys, etc. There are also companies such as Fox that fall under the umbrella, FX, Fox Network, Fox Sports, Sky, National Geographic. We have the studios that are responsible for making things like movies, the experiences with all the different types of theme parks, etc., around the world. A number of other media companies and television groups, such as the History Channel, Vice, etc. The direct-to-consumer channels, which are growing very rapidly, I'll talk about in a moment, ESPN, etc., etc. An enormous, enormous company. Very quickly looking at the revenue, so revenue growth has been fantastic through the past 15 years. And we can see that there was a bit of an acceleration going into the pandemic. However, the pandemic rendered a large part of their business completely useless. And so there's been a major drop-off recently, and the share price has risen despite this. And I think this is why a number of investors are getting nervous about investing in the company. I also want to talk about the fantastic success that direct-to-consumer has been. Everyone knows about Disney Plus, I think because it's more of an international product. This has grown from $442 million in revenue, one quarter, I think, after releasing the service, and then a year and a half later has grown to more than triple the size at nearly $1.5 billion in revenue. Fantastic growth. However, what people don't realize is that the direct-to-consumer segment, which includes these things that I mentioned before, has also been a major grower. And so from 2016 has gone from $0.6 billion to just 5 years later, bringing in nearly $17 billion. An incredible growth story. I mentioned it before, but Disney has reorganized their business segments. So at the moment, from this year, they only report across these two segments. There are sub-segments, whereas over the past 5 years or so, they have instead reported over these four segments. So this has made it difficult when I am taking the numbers in my spreadsheets and trying to munch them together to figure out what growth might be 1 to 2 years out. But I think I've done a fairly good job. I want to pull up the stock report for the company just so that we can look at the health of the company. Unfortunately, because revenue dropped so massively through the pandemic, which means that earnings also dropped off too, looking at historical PEs or any kind of fundamental ratios through the past, let's say, 12 to 18 months is pretty much nonsense. It doesn't tell you very much about the company. We can look at forward numbers and they give us a bit of a flavor of what is coming down the pipe, but again, those are based on estimates. So what I've done in some cases is I've taken ratios and numbers from historical years and sometimes made assumptions or excluded some of the black swan affected numbers that we've seen, because the lockdowns were a black swan event, and I believe that Disney is a fantastically run company that will recover completely from the black swan event within the next, let's say, 1 to 2 years. Something that is important to note and I use it within my calculations is that the operating margin for the business has been pretty much sitting at 25% for a long, long time before we hit the pandemic. The company is also carrying more debt than it had in recent years. Just that is another thing to note. Companies that were hard hit by coronavirus tend to have loaded up on debt in order to run their business because of the decrease in revenue. And so this debt needs to be serviced, and at some point it will need to be repaid. So it's going to affect the operations of the business and the accounting of the business at some point in the future. Right, the chart for Disney looks a lot like other companies that I've spoken about recently. So obviously there was the massive dip through March 2020, April 2020. Then the company recovered through to levels that it hit pre-pandemic. But the company also had the recovery plus growth story. Whenever you invest in a company, you need to ask yourself, what am I looking to get out of this investment? And sometimes you might be looking at that company as a recovery play. It still needs to recover to where it was pre-pandemic, or it's a growth story, a company that's growing very fast and has a large addressable market and is a fantastic business. Disney, because it's got such different business segments, I find it is partially a recovery story and partially a growth story. So I think the market got very excited about Disney Plus and the growing direct-to-consumer businesses, and so the share price ticked up quite nicely through the beginning of this year. Bob Iger, by the way, he offloaded about half of his shares, $100 million plus in shares in the beginning and middle of this year. I'm sure that didn't help the share price at all, and the share price has been bouncing in this range for much of this year. This is fairly typical of high growth companies. So the price shoots up for a period as investors get very excited about the company, probably overshoots the fair value. Maybe it sits at that level for a number of months, maybe years, maybe it drops down to a much lower level before picking up again. Part of the reason for the stock decline recently, so we're going into earnings season right now. We saw an analyst from Barclays downgrade Walt Disney, talking about Disney Plus. Any headline that it talks about Disney will probably include the word magic or some reference to magical because, you know, it's part of the Magic Kingdom. And so what has happened recently is that the chief executive, the new CEO, has said that they probably are going to see a slowdown in Disney Plus and the low single-digit millions of paid subscribers. This was to be expected at some point. There are only so many people that are going to subscribe to the service, and growth has been enormous through the past year and a half. But I don't think this will be a huge issue going forward. Disney, by the way, has a target of hitting roughly 230 to 260 million Disney Plus subscribers by the end of 2024. They're currently sitting around the 120 million subscriber mark, so they would need to double that number in a fairly short amount of time. This analyst is saying that they have downgraded the stock because they don't see Disney hitting those numbers at all, getting anywhere near close to it, because they need to more than double the pace of growth to at least the same level of Netflix. The thing that I would like to emphasize is that Netflix also had a few soft quarters in its history, but that does mean that the meteoric growth of the company stopped. Talking about Netflix, I wanted to highlight this point very quickly. So revenue for Netflix is $27 billion, and the market has awarded it a market cap of $282 billion. Why is this interesting? Well, going back to these numbers, Disney direct-to-consumer is growing very fast. 2020 numbers hit roughly 17 billion, and the forecast is that by 2022 kind of time frame, that the revenue from direct-to-consumer will be about $27 billion. Why is this interesting? What this means is that Disney contains a Netflix-size company, and if Disney contains a Netflix-type business that is roughly the size of Netflix with this revenue level, you might think that Disney contains a business that is worth $282 billion. Now, I'm not sure if you noticed, but the market cap of Disney at the moment is $311 billion, a mere $30 billion off of that number. And as I emphasized much earlier on the call, it is much more than the direct-to-consumer business segment that it contains. Netflix, on its own as a pure play streaming service, will always command a higher multiple than a similar product being offered in a much bigger company. There are various reasons for this, but that's just the way the market works. Even if Disney direct-to-consumer is only awarded a market cap of 75% of that of Netflix, hell, let's say 50%, then the market cap of Disney as a whole is undervalued. One of the other reasons that Disney share price recently has taken hit is because not so long ago, they announced that some of the big anticipated movies that they will be making have been pushed out a bit. So I think in most cases, they've been pushed out a few months. I don't think anything's been pushed out more than 12 months. And so investors are realizing that some of the revenue that would have been recognized in 2022 are going to now only be recognized in 2023. Again, I don't think this is a huge issue. I plan to be in the stock for many, many years. So the revenue will be recognized at some point. All right, this is all fine and dandy, but what does it mean for the stock price? This is a company where part of it has been hit by lockdowns. They've created a new suite of products that are growing very fast and that are making a hell of a lot of money. The share price is higher than it was at its all-time high pre-pandemic. I think it's roughly 13% higher than it was pre-pandemic. Does that mean that the share price is too high? Is it too low? Is it fair valued? Unfortunately, getting that picture is quite difficult for Disney for the reason that I mentioned before, but a quick recap. The way that it has structured its business and therefore its reporting has changed over the past few years, twice over the past few years. I don't think it's correct to use valuation methods on the headline numbers, on the overall revenue and earnings numbers when it comes to Disney, because the business segments within the company are just such different businesses. It is better to look at each of those individually and come up with estimates and then combine them in some way. And then finally, some businesses within Disney have been hit very hard by lockdowns, whereas others have benefited and are fairly new products that are still in their huge growth phase. So all in all, I think this makes it very difficult to value Disney, but I think I've done a pretty good job. Looking at the numbers on screen, the years 2020 to 2017 are finished, and so all of these numbers are the exact numbers. 2021 is still in progress, so I've had to prorate some of the numbers that we have available, and 2022, these numbers are a best guess based on various factors, which I'll talk about in a moment. I've pulled out these numbers according to the historical segments that Disney used to report on, because most of the data is broken down by these segments. And what I've used this for is to come to a revenue number that we might be looking at in 2022. I've also been looking at the operating margin, which is a very important number when it comes to Disney, and it is the linchpin in the fair value that I have come to in my calculations through the next, let's say, 6 to 12 months. Looking at the 2022 numbers, so for media networks, I've assumed that it more or less recovers to levels seen in 2020. More sporting events are happening, the same that we would have usually. So I can see this number at least recovering to where it was at the previous all-time high. For parks, experiences, and products, I'm assuming that the world does reopen and that there is no growth, that the number just recovers to 2019 levels. In terms of studio entertainment, again, I'm assuming that the level is slightly lower even than what we were seeing in 2019. And direct-to-consumer and international, this is the part of the business that has seen enormous growth. We have seen reporting through part of this year, but I've assumed depressed growth through the rest of the year, and growth, but much slower growth than we've seen historically through 2022 in order to get to this revenue number. What we can see is that through the past, let's say 3 years or so, the revenue number has been more or less at the same level because of the pandemic. However, if the hard hit segments of the business were to recover just to the levels that they were pre-pandemic, plus we continue to see growth in the growing segments, but slower growth than we've seen historically, I think it would be fairly easy for the business to achieve a revenue of roughly $91 billion. Now, given that the company historically has achieved an operating margin of 25% in normal times, if we were to say that were the case through 2022, then we would be looking at a target price of roughly $236 versus the $170 that we see today. So an uplift of about 39%. I don't know if they're going to achieve that margin because they are still in recovery mode. They're carrying some debt, and there's a price to service debt. They need to repay that debt. So the number might be, let's say, the number might be 21% through 2022, in which case the target price is roughly $200 for a return of about 17%. Now, obviously, there are a number of assumptions baked into this, but so any valuation model has a large number of valuations. We're trying to predict the future here. And so the recovery might take longer. Maybe it doesn't all happen in 2022. Maybe it leaks into 2023. But I think that I've also been conservative enough in my growth numbers to account for that eventuality. And so I really do think that my revenue number is more than fair in terms of what we might see for Disney through 2022. And so I'm looking for a price uplift from current levels of between 17 to potentially 40%. And that's just through 2022. I'm a long-term investor, and so I'll probably hold the stock beyond that. I think that we're likely to see continued growth as the business had seen in, non-coronavirus times. That's it for Disney, the entertainment behemoth. I hope you found it useful. If you have any questions or requests for other companies that you'd like me to review, please leave them in the comments. Have a great day.